All right, let's get into it. Today, we're breaking down the latest earnings call from General Motors. And believe me, this one was a real head-scratcher that sent some pretty surprising signals to the market. So let's just tackle the big question right up front. How on earth does a company report a massive $3.3 billion loss and then see its stock jump over 8% to a record high? It sounds impossible, right? Well, let's unpack what Wall Street was actually looking at, because it sure wasn't that headline number. When you first glanced at the numbers, it was a classic mixed bag. Some good, some not so good, and one figure that looked, well, frankly, just awful. But this quarter is the perfect example of why you've got to read beyond the headlines. Investors basically ignored the bad stuff and honed in on a completely different story. Okay, so first, the good news. The adjusted earnings per share. GM posted $2.51, which solidly beat what Wall Street was expecting. That was the first clue that operationally the company was actually doing pretty well. But then, bam, you see this number, a net loss of $3.3 billion. Now, this is the GAAP number, which means it includes everything, even one-time costs. And yeah, it seems to totally contradict the nice earnings beat we just saw. So here's the absolute key to the whole story. The market looked through that giant loss. Why? Because it all came from a $7 billion one-time charge. See, management was basically taking its medicine now, retooling their whole EV strategy to deal with slowing demand. So investors didn't see a failure. They saw a smart, disciplined move to stop the bleeding on EVs for the future. And just to make things more confusing, revenue also came in a little light. So, you've got a huge loss and a revenue miss. You're probably thinking, where is the good news here? Why did the stock go up? Because the real story, the one investors actually cared about, had nothing to do with accounting losses. It was all about two simple things: cash and what the company planned to do with it. First up, GM announced a brand new, massive $6 billion share buyback. That is a huge vote of confidence. It's management screaming from the rooftops that they think their stock is cheap and that they are about to generate a ton of cash. And they didn't stop there. They also jacked up the dividend by 20%. The message couldn't be clearer. They were basically telling shareholders, look, we are a cash machine, and we're going to give a whole lot of it back to you. So, with those two moves, management completely changed the conversation. The story was no longer about GM burning through cash to chase the EV dream. Suddenly, it was about a disciplined, profitable company that's focused on returns. They went from being an EV drag to a cash cow almost overnight. And you can really see the shift here. The old story was EVs at any cost, right? Lots of spending, lots of uncertainty. The new story? It's all about smart, right-sized EV spending, showering shareholders with capital, and making money off the stuff they're already good at, like software. And the game plan is pretty straightforward. 1, take the hit on EVs now to be more profitable later. 2, get a handle on billions in potential tariff costs. And 3, keep growing those super high-margin software businesses. I mean, look at that growth in OnStar and Super Cruise. That's fantastic stuff. But look, a new narrative is great and all, but it's just talk until you back it up with hard numbers, right? Investors needed proof, and that's exactly what GM gave them with their guidance for 2026. This is what really sealed the deal and made everyone believe in the new plan. And wow, did they deliver. I mean, just look at these numbers. Across the board, on profits, on earnings per share, and most importantly, on free cash flow, GM's official forecast was higher than what the analysts were predicting. That was the mic drop moment for the market. And then CEO Mary Barra just drove the point home on the call. She connected the dots for everyone, saying those big charges they took will lead directly to lower costs and a return to their target profit margins. I mean, that is just music to Wall Street's ears. Okay, so let's put it all together. After digging through this report, what's our take here at Talk Tickers? How do we see GM shaping up as we head toward the next quarter? So after all that analysis, we're initiating our coverage with an outperform rating on General Motors. So why outperform? Well, here's our thinking in a nutshell. First, this pivot. It's credible. It's exactly what shareholders wanted to see. Second, that huge capital return plan puts a really strong safety net under the stock price. And third, the guidance was a clear beat, which tells you the core auto business is humming along. So what's next? We expect more of the same discipline. The stock will probably cool its jets a bit after this big run-up, but the real test is going to be whether they can actually hit those ambitious cash flow targets. If they can, there's a lot more room to run. And of course, a final reminder, this is not financial advice.